let's do the same old stuff that we did last time. Let's check out the markets. You guys know what's the big momentous event, right? $1,000 gold. That's the big news. $1,000, of course, is just a round number. Nothing has fundamentally changed in the markets. But at least having a 4-digit number is believed to be a momentous event. Well, probably it won't make much or any difference at all. It is going to be a gradual shift. Just because it's 1,000, the masses won't wake up. That one is for sure. So, pulling up gold, you see 1,000 just got it hit today. Let's clarify, what is it, 14th of March. It's trading around 1,005. So, you still see gold is breaking over 1,000. You still see here you got moving up. But this here is reversing. Again, very hard to make a call at this point whether this will be the top or not. My decent expectation is that it's going to get into another overbought territory, probably around 1,020 up to possibly even 1,050 before you get into overbought and a meaningful retracement. Retracement is the same as correction down back to possibly the 950 area or something close to the 50-day moving average. Okay? The other super big news, well, it is no longer news anymore, is the dollar crashed yet again. Let's try first the XEU, the euro, and then the USD itself. You see what happened? Out of 154, you had a little gap here, 55. Now it's 156 and pushing steadily into 157. Again, notice the run-up from 144 to 157. That's quite a significant move in barely 1 month. You also see that the euro is getting extremely overbought territory, and this one is getting to peak. So, for all intents and purposes, the expectation is that this is some sort of a intermediate blow-off top, and then you're probably going to get a retracement back close to the 50-day moving average. Again, that's the working hypothesis. Of course, it is extremely hard, next to impossible, to pick the exact day or date of the blow-off top. But nonetheless, this is a working hypothesis. 155, it broke through 156. There is no any historic resistance to take a look and see for a next meaningful. Now let's go back to USD. USD, of course, was the mirror image of the euro. It crashed yet again, not a major drop. Let's try and shorten a little bit the months, maybe 8 months or 7 months. So 0 years and maybe 8 months to blow out these candles and see. Okay, so you see here yesterday this huge drop. This is what is known as wide-ranging day. This wide-ranging day, you go back, yes, there was one here, which was the beginning of the leg down. There was one here, and when we go back, it is hard to see. Okay, here's another wide-ranging day, but the point is that here, this was an extreme day, extreme volatility, and here again yesterday, another extreme volatility. Let's take a look what happened in Dow Jones Industrial Average. In the meantime, okay, he's scrolling back, we're going to be looking back. You see, this fear, this was a major relief rally. Then the market opened a little bit, it rallied, but it could not hold. It was a negative day. Then again, same story, and now you're seeing the market is losing traction, meaning all of this relief rally, most of it is, or at least half of it is already lost. So the market is not showing any ability to sustain the rally. It actually hasn't sustained anything. So this shows a profound fundamental weakness in the market, not in the fundamental sense of fundamental analysis, but in the sense that the market doesn't hold its own gains even for a day or two. So this shows trouble. Probably it's going to fall back again. Maybe it's going to test this support level. Probably the support's going to last one more time. That will leave a little bit of a confidence in investors, and maybe down the road, it's hard to say exactly when, but here's an important point. It is not too low, so it's got a room to fall, and it's not yet oversold, so there is a room here with the next week, 2 or 3, that the market breaks under this support level significantly lower towards 11,000. What's next to look at? TLX. Let's take a look at the interest. So the idea is basically to look at a couple of commodities, then a couple of currencies, then a couple of the stock market indices, then a couple of, let's say, the interest rate. Well, you see that this here, which is that, it's sometimes called island reversal, sometimes is the blow off or the gap or whatever. It's still holding. Now what it's trying to do today or for the last couple of weeks is actually fill this gap here. So it is filling. Are you zooming in properly? You gotta keep zooming constantly, or at least keep it zoomed in so that everybody can see. So well, this gap here, it's trying to fill back the gap before it moves higher. It may not. It is hard to say. But at least this for now is the working hypothesis that this represents the true bottom here. This may be a retesting of the bottom, and that yields will begin to rise. Okay, let's try the S-SEC, which was the Shanghai, and see if that bubble keeps bursting or not. Oh, you see what happened since last time? This was a support level here, that's 4,200. This 4,200 more or less held because it closed on that particular day here above it. And it held up until that day, which is the beginning of the week. By Friday, you see 4,200 is a memory, 4,000. So the market is rapidly falling. Also, it's pulling or dragging down the 50-day moving average. And the 200 days beginning to flatten and to reverse. Again, the hypothesis is that not yet completely oversold, a little bit of room to go. So it's going to fall to 38 or 36. Recover back to the blue line, maybe 4,400, before another major leg down. Again, it's just a working hypothesis. You just got to watch it day by day to confirm it or possibly reject and change the working hypothesis. But the idea of a technical analysis that you have to have some working hypothesis. You got to be clear on the short term, possibly intermediate and long term, and you got to keep every day or every week that the hypothesis, the working hypothesis, has not been violated, so that you have to rework and construct another or a new hypothesis. And let's take a look at the Nick, right? The Nikkei with double K. Alright, so this was a major low and a major support level. Perfect rally, if you remember, for the 50-day. It pulled back, so now it's losing ground again. So this low here, now it seems like the Nikkei is weak. Well, it is testing it right now. At this point, it is hard to say. Maybe it's going to rally back to 13.5. Maybe it's just going to fall off to 12,000 before it rallies back. Very hard to say at this point what's going to be the short term. The long term is clear. You got a falling long term 200-day moving average. You got a falling 50-day. So the long term is clear. At this point, it is a risk to take a position. At least that's my opinion. A risk to take either a long or a short position. This is not the time to enter your positions. At this point, if you're not in, you shouldn't be doing anything. If you shorted somewhere on top, you might consider closing out. In this type of uncertainty, one of the strategies is, whatever your portfolio is, you just close out half of your shorts. You cash out half and let the other half ride more profits or some more losses, or surrender some of the gains, whatever happens. So that will be a good time and place to close out partially your shorts, if you have your shorts. If you have a long position, again, very tricky. You might hold out for the pullback to close out and liquidate. Again, very hard if you have a long position. Have a long position means you made a bad decision before, a week, a month, 3 years earlier, sometime before you made a bad decision. You're suffering the consequences of it now. So now the situation is, might bifurcate, market falling off a cliff, or just recover. You're in deep trouble. You should not have let to the point of even having a long position and leave it here at all in the first place. You understand that one? All right, do we have anything left for the markets, or we get back to, well, maybe the VIX, or, gold, silver, let's see. Oil, of course oil. Man, how could we miss oil? Oil, records. 110, 111. Yesterday it was 111, 111 today. See what's going on. Relentless rise from 87 all the way to 111. This is what, like $14 increase on an 87. What's the percentage of 14 on an 87? Like 20% roughly increase in one short month. That's one hell of an investment. Can't just be, maybe possibly with wheat, but 20% rise in 1 month, and they still tell you you should buy Dow Jones, right? Again, that's still what you will hear on CNBC. Well, it is getting or pushing towards overbought. Again, this 20% rise, it can't just rise another 20% from here. Here is a safe place to effectively liquidate some of your positions, meaning you cash in some of your profits, and maybe let a little bit ride if you want to trade. Again, depends. Are you a short-term trader or are you a long-term investor? If you're a long-term investor, you do nothing, meaning you were smart, you bought way back when, you're riding major profits, you're a long-term investor, you enjoy your wealth, get a vacation, right? If you're a short-term trader, however, this is a good time, close to over here. This one is also rising. You see this peak is here, so we're getting close to that peak there. So it might be a good time today at 111, just sell out some or most, or if you're a truly bold trader, you sell it all out and take a modest short position in the expectation of a reversal and a pullback to the 100 level or to the 50-day moving average. Is this kind of helping you guys? Is this good enough for today and get back to the fundamental stuff? All right, on the fundamental, let's get back to those charts. All right, so hold on to this chart. So, last time I said these are the 60s. You see that was the oil crisis. So then you have, let's see, 79 and 80, 82 and 83 was another painful recession. And that recession resulted in a really small increases in real estate. Now, some of the worst returns were in 90 and 91. 1991 was, first of all, a recession. What's characterizing 1991? Anybody? This is the final blow-up of the S&L crisis. What was the S&L crisis about, guys? Anybody? S&L was about savings and loans that loaded up in mortgages and were lending wildly and massively in the period. They were around the 80s in trouble already, and they started to inflate by buying a lot of these junk bonds that Michael Milken was issuing. And also they were financing real estate. So S&Ls were the driver on the one hand of the mortgage and real estate market, and on the other hand of the junk bond market. So when these two kind of like collapsed, let's say the junk bond market collapsed, it also took with it the real estate market, meaning the S&Ls blew up big time. Well, S&Ls were in deep, deep trouble in 1980 and in 1982. Meaning the following. They were, throughout the 70s, borrowing short and lending long. Borrowing short and lending long is the typical sin that a banker commits during low interest rate environment. This is when every banker commits himself to a disaster whenever interest rates rise. Well, interest rates always rise. Maybe a year from now, maybe 10 years from now, maybe 20 years from now, but interest rates will always eventually rise. And when they rise, the banker is, of course, bankrupt because he borrowed short and lent long. What does it mean? You borrow at 3 or 4% interest rate when you're short, and you lend at 7 or 8 long. When interest rates rise to 10 or 12%, you gotta pay 12, you're getting only 8. You run out of capital, meaning you run losses soon, and very soon you're bankrupt. This is exactly what happened in 1882 when interest rates skyrocketed. Short-term interest rates skyrocketed to over 20% in 1980. That's Paul Volcker jacking up interest rates to kill inflation. Well, he killed inflation, but with inflation, he also killed these S&Ls. And the government made a great mistake. It tried to revive them and revitalize them and tried to give them a second lease of life throughout the 80s. And what would have been a 2, 3, some estimate up to $5 billion problem in 1980 to liquidate these, let's gotta understand it. The smart guys are the bankers. The S&Ls are kind of like savings and loans. They're not true banks. And their managers aren't as smart. They're pretty mediocre. Plus, Michael Milken would not be easily working and scamming true, genuine bankers. But these guys were, fairly mediocre to the point of being dumb. Well, they were also greedy and they were also in trouble at the same time. So Michael Milken and Wall Street pretty much screwed them up big time to the point where rather than the government shutting them down, pay up $5 billion and move on in life, the government gave them a second lease of life. And these guys, being in deep trouble, tried to make an awful lot of money. What is the way to make good money? Well, you buy high-yield bonds. We just called them junk bonds, and Michael Milken was supplying them without limit. High-yield bond is just a piece of paper that promises to pay a lot. You want me, I'll issue you $1 billion. No problem. Well, you want 50 billion? No problem, 50 billion. You want $1 trillion? Here's $1 trillion. I mean, the supply is unlimited simply because it's paper. It ain't oil and it ain't gold either. Just a piece of paper, and if it ain't enough, you just put in another zero. It takes care of the problem of quantity of supply. Well, quantity increases means quality rapidly deteriorates. The result is that these guys being in trouble, they went for the high yield, 10, 12, 15% high yields to get themselves out of trouble. Well, the result was that these junk bonds turned out to be what the name was, namely junk, just like subprime today is turning out to be indeed subprime. So it didn't pay back, and they were loaded up with now hundreds of billions. Well, the result was that a $5 billion blow up, in order not to incur the $5 billion cost, resulted in the S&L crisis that is estimated to be between 200 and 300 billion, if given by the Federal Reserve and other bankers. But other economists would say 500 billion is a much more realistic, as the blow-ups and the bailouts continued later in the 90s. Lesson is that a small problem that could have been liquidated at the cost of 5 billion turned out to be in the 90s a 500 billion, 100 times bigger. You also see this mad rush over here, that's the real estate bubble, and you see in 2006 the growth is not as much, and later on it's actually falling. Any questions, guys? Time for a drink, or let's move on. Oh, let me see what this is. Alright, this is, you can actually read it up, you gotta zoom in quite a lot up the top there. No, it's zooming mostly for that camera guy. December 2007 sales in medium pricing percentage change from December 2006. And see what happens. Now, we're talking here California. This is the wildest of real estate bubbles ever, except possibly for the Japanese real estate bubble in Tokyo in 1989, 1990. You see, this is called Marin County. You see, units dropped 31%, the price dropped 2%. That's good. That's really good. Why? Because you look at the Sonoma County. Sonoma County, units down 50%. Wow. Meaning the number of houses that were bought or sold, meaning for every bought there was one sold, it's the same house, fell in half. And the median price fell 20%. You gotta understand, it's one hell of a crash. However you slice it, however you dice it, this is a 20% drop in the median price is a total disaster. Alright? Then you get to the Napa County, you see, almost 50%, 46.6. Prices fell a modest 3.9%. Or is it Solana County, 51%, and prices 17%. Contra Costa, I don't know, this one is almost 20% drop in prices. Alameda, so you got to scroll just a little bit. Yes, Alameda County, 10%. Oh, only Santa Clara County still holds up even though the volume is going down. Alright? Santa Cruz, 4% too. So, home sales were slow last month in the Bay Area during December and last 20 years. So, we're talking about the slowest sales in 20 years. The point here to understand is that the bubble in California inflated to the latest and began bursting the last, except for possibly Washington, D.C., where the printing press is still working overtime and keeping those property prices inflated. So the point is that it takes barely, and I mean barely, 1 year to wipe out sales and gains for 20 years. So you got to see how precipitous the drop is, that in one short year you get to lose effectively, the slowest in the last 20 years. Alright, let's see what's next. There, the median house price in Santa Clara rose partly because, here's an explanation. Homes in expensive neighborhoods are selling more readily than those in less expensive areas. In other words, on the very high end, people were still having money and still making a lot of money. So, if the home was a 1 million home, it would sell easily, at least in the Santa Clara County. Alright, any questions here, guys, before we move on? Any? None. Alright, let's move on. Asset-backed securities growth. Okay, this is part of the other course, at least those that are coming. The fuel, the driver of the real estate bubble. Asset-backed securities in general, not only real estate bubble, because asset-backed securities, this is a security which is backed by some asset. That asset may be a student loan. That asset may be a credit card loan. That asset may be a car loan. That asset might be some receivable of a hospital. So it could be a whole bunch of other things, but it would also be a mortgage in the asset-backed securities. So you see what's going on. Modest, a little bit of rise, 98, then 2001, and then in 2003. It is easy to see how 2003, especially 2004 and 2005, represent, at least from this picture it's clear, the blow-off stage. Because the asset-backed securities are those, or partly, big part of the driver of the credit expansion. In other words, one of the major instruments of the credit expansion were asset-backed securities, and from this picture it's easy to see that 2, 4, 5, and 6 is clearly the blow-off stage. Of course, once you get and be done with the blow-off stage, what would, I'm trying now to do macro fundamental analysis, what I expect to do between 8, 9, and 10 is to revert back to the mean somewhere in the 90s. So, you gotta be seeing these levels deflate back to the averages here from 90 or 100, so to fall 8 times in order to say we're back to normal, okay? Because at least this for now represents or appears to represent what's normal, and this appears to be the abnormal. Again, that's the working hypothesis in a macro analysis. Alright, let's move on. See, asset-backed securities growth. Well, this looks like the same picture. It was probably updated at a later time. Alright, so let's see what's the name of this. Adjustable mortgage. Is it resets? Yeah? Alright, so you guys know what's a reset? No? Alright, well, how about those that were like 2 hours ago listening to Peter Schiff who was talking about these resets? So, these are ARMs. ARM stands for Adjustable Rate Mortgage. Adjustable Rate Mortgage means that this is a mortgage whose interest rate is adjusting according to market conditions. But ARMs, or Adjustable Rate Mortgages, are not, when issued, are not beginning to adjust immediately, the same month. Usually ARMs are set up initially when they are issued, originated, for 2 or 3 or 5 years of a fixed interest rate, and on the 5th year the interest rate begins to float or co-float with LIBOR or the Fed funds or some other market determined interest rate plus a particular markup or a premium. So the idea is that the mania, the crazy stuff that happened in 2003, 4, and 5, most of the ARMs were with a 3 or 4 or 5 year reset period. So it was issued in 2003, it will reset in 2008. Alright? It was issued in 2004 with a 3-year reset. So at the end of 2007, the reset will kick in. Well, they were issued in an environment of extremely low interest rates. In other words, because Greenspan pushed interest rates to the unreasonable level of 1%, everyone was taking ARMs at extremely low, 2 or 3% interest rates that would adjust 3 or 4 years later. Everybody knew that it would adjust to twice the price, or 3 times the price, meaning the interest. So you're taking it at 3, and it will readjust to 6 or maybe 9. Well, is that a problem? The answer is, if you're the speculator in California, not a problem, because in 3 years you're going to sell it, meaning the house, and you're going to be a millionaire, and you don't have to worry. Alright? But the problem is that someone else got to buy it, and he's got to pay either the higher interest rate or do the same game. In other words, the game can go on as long as interest rates stay low. When interest rates rise, someone is going bankrupt, either the bank or the borrower himself, alright? Someone ultimately has got to pay the high interest rate. So, these resets simply say, hey, if this is what's coming down the pike in terms of resets, these are, I'm going to tell you how much or what is the risk coming in the pipeline in terms of defaults, because these folks will not be able to borrow. So, you see, we're talking for each month, what the resets are. And the big talk was that here you have in 2008, meaning this year, you have a massive, and I mean massive wave of resets. And again, look at the numbers. The numbers is MM, so these are 40 billion. We're talking about 40 billion will reset in 1 month. Out of these 40 billion resetting in 1 month, realistically we can say that probably half will blow up, okay, meaning will go in default. So, you got 40 in 1 month, you got 40 in another month, you got 40 in the third month. So every month you got 20 billion blowing up, and before long, you get in a year 200 billion. Well, banks are going to run out of reserves, meaning their losses will be, more than their total capital. So, what this is saying is, hey, this is where the problems are still coming down the road. Now, let's say January 2008, in April, meaning next month, in 2 weeks, you still have a lot of resets, and these resets will be causing more problems down the road. So if someone is thinking or telling you that the subprime is pretty much over and we're getting close to back, and say no way in hell again or heaven, you still have, the gun is loaded fully and you still have a lot more coming down the pike in order to be safe and clear and out of trouble. So this is also part of the credit crunch, but the credit crunch is part of the the macro picture and the macro environment in which you got to invest if you're investing in Dow Jones. Alright? Guys, any questions here? Any questions? Alright, let's move on. Okay, well, this shows us the ratio of AG stands for silver versus Dow Jones. So it simply tells us that the value of silver has been dropping relative to Dow Jones. This is mostly for silver analysts. And you see that somewhere in 2001, silver began to rise up against Dow Jones. Nothing of interest. The picture is pretty much the same as gold versus Dow Jones. And of course, it won't be that much different in nature from oil versus Dow Jones, but just another illustration. We shouldn't waste much time for it. Alright, this is agency MBS growth. Well, someone else want to ask me about this agency. What is agency? Agency refers to government agency, which refers to what is known as GSE. GSE stands for Government-Sponsored Enterprises or Government-Sponsored Entities. Alright? And these are, their names simply called Fannie Mae and Freddie Mac. Well, there's now another one which is obscure but actually the pillar of the real estate market called FHLB, Federal Home Loan Banking or Bank. So it was designed in the early 30s at the depth of the Great Depression, because back then it was believed that the cause or the source of all evils during the depth of the Great Depression was, guess what? You guys that are asleep, it's Friday night, you want to just go home? The problem was the same as it is today. The evil was falling real estate prices. Back then, the big ballooning of the banking system itself was nothing more and nothing less than real estate mortgages. I mean, if you look at what's been going on over the last 5 or 10 years, it is a pure repeat of the 1920s. And the falling real estate prices now are believed to be the curse of the banking system that will result in a major collapse of the banking system, because real estate prices are serving as a collateral of these loans. So as the collateral value of the collateral evaporates, so does the value of the loan. And evaporating value of the loan means evaporating bank capital, and with that, the bank itself is technically bankrupt. So back then it was realized that, oh, the disaster can be stopped if we just create a government agency that will buy up and generate mortgages to support real estate prices to the high level. Okay? Well, the point is now that, again, as the problem started surfacing again, see, these were here, 97, 98, especially over here, the agency served 2001, 2002, 2003. This is the stock market bubbles bursting. This is the dot-com telecom bust. And if that was the bust, there had to be something or something else to inflate in order to sustain the system from total collapse. Well, the inflation was generated through agency debt. MBS stands for mortgage-backed securities. So Fannie Mae and Freddie Mac will issue bonds, and these bonds will be backed by mortgages, all right? And they will have the implicit guarantee of the U.S. government. So it's kind of like, oh, they're safe and they're secure, all right? So they were instrumental to the reflation of the bust, and they were instrumental to deflate the stock market bubble, but fuel the credit and inflate the real estate. Well, in 2004 and 5, there is a sudden drop. Why in 2004 the real estate bubble, which the GSEs were blowing, did not blow up and burst? Why? Well, guys. Well, because Wall Street found other instruments. So, Wall Street, structured finance, SIVs, and all of these structured products were used as the instrument to further inflate those CDOs and CMOs, collateralized mortgage obligations. So, in 2004, Wall Street structured finance started to raise dramatically, and it picked up the baton of credit expansion so that the GSEs need not expand so rapidly because Wall Street was able to expand. Well, if Wall Street is able to expand big time, meaning has the instruments and everything else, why would be this sudden and dramatic collapse here? Why wouldn't they just drop a little bit? The answer is simple. Wall Street is a lot more powerful and politically connected. So the minute they have the instruments ready and working, they will shut down, or meaning lower, the ability of the GSEs to expand through political means. GSEs, Fannie Mae was in deep trouble at that time, so they put a cap on their growth, and the idea is that the minute you put a cap on the GSE, Wall Street can flourish, and flourish it did until 2007, and now this credit crunch. Is that questions, guys? Any questions?
Well, given that, I mean, the lessons from the 1930s were pretty obvious, how would you interpret the Fed's recent, again...
doing the same thing. Well, one way to think about it is political pressure is something that cannot be resisted. Plus, number two, historically there have been bubbles over and over and over and over again, and humanity doesn't seem to learn anyway. We have bubble bursting last year in UK, and Bulgarians are still in denial that we have a bubble here. Zero learning. I mean, are we stupid or what? Again, the answer to this, of course, as I explained with last time, is inflation does brain damage. It damages critical thinking. So, once you get inflation going on, sound thinking is usually completely impaired. You cannot think for yourself. You join the herd behavior, and there you have it. Every Bulgarian is in denial today that have a wild bubble. There was one in the US, it just burst 2 years. You see what's going on, the total devastation in California. You have the total devastation now in Spain, ghost towns and everything else. We now have big problems practically everywhere. Practically, not quite everywhere in Europe. And yet in Bulgaria we're in 100% denial. You know, they just call me crazy because I'm calling it a real estate bubble. Just like, you know, guys watch it, you know, 2 years ago, they were calling Peter Schiff crazy and incompetent because he was calling a real estate bubble, alright? I mean, they just call me smart. I mean, that's okay. Again, that's at least what I do. I study bubbles, I try to teach bubbles, and occasionally I do preach bubbles, but, alright? But that's what I do. I am a student of bubbles. I'm a student of history. Next time I'm going to bring you a couple of books, market history, history of speculations. What is history of speculations about? It's about one and one thing only. It's about wild bubbles, about the madness of the crowd, where crowds suddenly believe that tulip bulbs will make them rich, or whatever. You know, there's always some object of manias and speculation down the road. It always ends up in tears and disaster. There hasn't been a single bubble that has not ever burst. I mean, it's a basic economic law. What a bubble does is shift scarce resources into a less productive use and diverting resources from more productive use. So the bubble simply means diverting or shifting back the resources to their better, more productive use, like actually drilling for oil today, alright? So, $120, well, $111 oil means that these people are now waking up that we better start drilling, and start drilling even deep in the ocean, alright? So that's what it is. Again, let's move on. Did I finish? So the answer is, hey, this is what human nature is. Plus, there is that problem of actually learning things, okay? Plus, there is that other bigger problem of ideology. Now we are in the process of, you know, as George Soros called it, and you're in the other class, market fundamentalism. Oh, it's no problem. Market's going to take care of itself. Market's, it's going to, whatever the problem is, market's going to solve it. Yeah, but a market's way of solving it is a blow up, okay? It's not a smooth transition. At least it never has been in history, and now would be a major shift from thousands of years of history, a major shift today if suddenly the market solution is a smooth and painless transition. Again, it hasn't been observed before. Again, if you guys know such a case, well, let us together become Nobel Prize winners, all right? Of how to take, you know, care in a smooth manner of a bubble that has been blown to, you know, major unreasonable proportions. Is this kind of answering questions? Again, Wall Street is much more powerful than Ben Bernanke. He's a puppy. You know, he's like a little ant, and Wall Street is like a big elephant. So, you got to understand, central bank's job is to protect commercial banks, to protect Wall Street. It is of Wall Street, by Wall Street, and for the interest of Wall Street. This is what the central bank is about. So, its job is actually to protect Wall Street. And the protection of Wall Street will mean sacrificing the rest of the economy, businesses, people, etc., etc. Essentially, the protection of Wall Street has been what? A 200 billion drop the other day. And now what's the Wall Street saying? Oh, that 200 billion drop, helicopter drop, right, wasn't good enough. We need another 200 billion. Well, Ben Bernanke's already delivered like 500 or 600 billion drop, helicopter drops, and Wall Street is eager, greedy, and still saying not enough. Give us another couple of 100 billion until the next month, and then another 100 billion. You know, that's the way it works. All right. So let's move on, Nick, to see what's next. World silver production, alright, it just shows you what the silver production is. Not really interesting, at least for macro fundamentals. It's more interesting for specifically chart H, monthly mortgage rate resets. Alright, so These are the same resets, guys, that I was talking about, 2007, and you see here, this peak here represents 2008. And 2008 represents the peak of resets. Resets means the dread of Wall Street, because at the reset, it is clear that the borrower, when the reset comes, will not be able to pay. Why? Because the original interest rates was low and under the market interest rate. We call this negative amortization. Negative amortization means that the interest rate that the borrower paid was lower than the market interest rate, and the differential is put on top or added to the principal of the mortgage. So, when the reset comes at a market rate, let alone to compensate for the higher principal, it is guaranteed to blow up. Everybody knows it. No economist denies it. Remarkably, in 2006, everybody denied it that this would be ever a problem. Again, Petrov was the one and lonely voice who said, hey guys, it ain't going to last forever. The resets will come in 2007 and 2008, and the system's going to blow up in Wall Street's face. And some of you watched Art Laffer, how he was laughing at Peter's shift. Well, now things are different, The now 2008 picture is completely different. So, you also have another peak over here. Again, you can also see the different types of debts. So, these are different mortgages, different types of debts. You see agency, that's Fannie Mae, Freddie Mac. You also see prime. Prime means good, high quality borrowers. Alt A means borrowers that are not bad, meaning they're not junk, but they aren't perfect either. In other words, prime means this person satisfies these 5, 6, or 7 criteria. And this person is excellent credit. Well, this is not excellent, but it's very good. Maybe 1 or 2 of the criteria are not quite perfectly satisfied, but otherwise the borrower is deemed okay. And it's called Alt A. And then you have the subprime. The person's got some major problems, whether with his income, whether with prior borrowing, defaults, delinquencies, and whatnot. Somehow his credit was damaged substantially. This is considered a very high risk. Now, there is that thing called option adjustable rate. Adjustable rate, I already was explaining. Adjustable rate is the same as R, adjustable rate mortgage. Well, option R is a particular mortgage which buys breathing time for the borrower and at the same time for Wall Street, where you do not have to pay the full interest rate on your loan, and you don't have to actually pay down the full interest and a little bit pay down on the principal. If you choose, you may possibly pay only 1/3 of your interest. Again, the option means that it is at the option of the borrower how much of the interest to pay. So he might pay only 1/3 of the interest, and the other 2/3 will be added on top of the principal. Again, next time he's got some nice, big, juicy income and contract, he can throw in a big payment and pay down that interest and quite a big chunk of the principal. So, as the uneven income flows into the borrower, he can pay down in the uneven. He is not bound to pay $2,000, $2,000, $2,000, $2,000, and if he can't make $200, in other words, he can pay only $1,800, technically he is in default. Well, why would borrowers choose option R? This is crystal clear. It provides them a great flexibility. Then, why would Wall Street choose option R? The answer is that if, for example, the borrower can't pay the $2,000, but just can pay $500, the borrower could just keep paying $500, $500, $500, and there is no default. At least technically, there is no default. So if technically he has not defaulted, Wall Street is not required or obligated to write down the loan and accept the loss, to recognize the loss. So it makes Wall Street books look a lot better than they actually are. So option arms are a very exquisite manner to cook Wall Street's books. Well, it only means that if you're sustaining certain losses, now you're going to be reporting them a lot less until those losses must be recognized when you gotta report a whole lot more, as has been happening over the last 3 or 4 months. All right? Is this guy making sense? Is it? Questions? All right. How much time do we have? 10 more minutes. How much on the video? Let's move on, Nick.
It doesn't show.
Oh, it doesn't show? Are you watching anything?
It says how many minutes we have.
Okay, so how many minutes we have?
80 minutes.
Okay, so we probably got another 10 to record. Alright, so these are Asian indices. You can just see Shanghai Stock Exchange. Of interest to one of us is the second one, which is the Hang Seng Index, right? Yes, the Hang Seng, that's the index of Hong Kong. So, if you are from Hong Kong, you live by the Hang Seng and die by it, right? Alright, so let's take a look at Hang Seng because we don't care about the rest. The Nifty 50 Indies, we don't care what happens. But, you know, our fate is linked to that of Hong Kong and Hang Seng. So this will be this one here. So you see from 2003 to 2007, and you see from 1,000 you invested in the Hang Seng, you will be making a fairly decent return. So you would more or less double your money in Hang Seng. Of course, you would have done a lot better just put them in oil, and even a lot better if you just put them in wheat, but that's a different story altogether. Essentially what this picture is saying is that as the US credit monetary system is expanding, and the credit expansion drives current account deficits, the current account deficits enter the reserve base of these East Asian countries, and the reserve base blowing up or ballooning results in a credit expansion in East Asia too. And that credit expansion is filtering through Hong Kong real estate and the Hang Seng, right?
Yeah.
Hong Kong real estate, is it a hot investment?
It's very hot.
Very hot investment. No doubt.
The prices are skyrocketing.
Yes, the prices are skyrocketing. From my understanding, Hong Kong real estate is now, from what I read, more expensive than in New York, more expensive than in London. But I've been reading recently that the most expensive real estate is actually where, guys? Moscow, yes, Moscow. That's so. I don't know how Hong Kong compares to, but Hong Kong real estate compares to Moscow prices. But in both places, it is crazy. Why Moscow? The answer is very simple. Russia is expanding credit at the fastest and money supply at the fastest rate in the world. 50% credit expansion and roughly 50% money supply is faster than Bulgaria or Hong Kong or China. China is expanding at 20%. So you get the fastest credit expansion in the world, meaning at least from major countries, and of course you're going to get the wildest of all real estate bubbles, so that's perfectly normal to expect from a purely monetary point of view that Moscow's real estate will be the wildest, alright? Let's move on. Alright, this is asset-backed securities. This picture perfectly ties, perfect match with 3 pictures ago with the GSEs. Remember the government-sponsored entities? Remember what was the picture back then? Very high 2001, 2002, and 2003. And then the GSE volume collapsed big time. Well, now this is the explanation. ABS, asset-backed securities, is the manufacturing of Wall Street. This is what Wall Street produces. It produces securities, asset-backed. So, in 2004, Wall Street picked up the baton from the GSEs, and Wall Street made that wild expansion of credit to compensate for the GSEs and then some more. Alright? So this explains again, macro fundamental analysis is ultimately about looking into the credit system and how the credit system works and how and in what spheres it spills over. Whether it spills over to stocks or real estate or commodities or the stock market, whatever. I don't know. So that's what you're trying to see. Is credit created? And where is credit going? Or if credit is deflating, which area or sector is deflating? Again, you answer these questions, excuse me, you're going to figure out which are the right asset classes to invest. Once you figure out the correct asset classes to invest, the rest is relatively easy. In the sense, once you know you're in commodities, again, you don't have to be a very competent. You can pick up wheat and you're going to do okay. You can pick up uranium and you're going to come out alright. You can pick up gold or silver, almost any commodity as long as you got the asset class right. The true art is actually figuring out which are the asset classes. The rest is grunt work. And if you're highly incompetent, but you still get the asset class performance will bail you out. You understand what it means? If the asset class performs 35 and you made a really, and I mean really bad pick out of the asset class, well, then you're just going to get 20, 25, which will be great. If you were really good and you picked the better commodity, meaning last year you picked wheat, of course, you're going to be a true, genuine winner. Is that clear, guys? We'll move on? Alright, let's move on and see what's next. LTV. Okay, this is the auto finance companies. Okay, what's LTV, guys? LTV. Is it time to go home? Looks like it. Alright, so LTV stands for loan to value ratio. Loan to value is how much money they give you out of the purchase price of your car. So, if the car is 20,000 and they give you 10, the LTV is 50%. If they give you 15,000 out of the 20, it's 75%. And if they give you 21,000 for your 20,000 car, it will be 105%, right? So, LTV measures the leverage which borrowers take, and it also measures the risk which lenders take or make, or the risk that they assume, because the higher the LTV, the higher the risk that when the asset depreciates or just falls in value for some other reason, the lender is vulnerable. So what you see here again is 1980, 1982, lenders have been relatively conservative. Why? 80 and 82, skyrocketing interest rates, a general credit crunch, hard to find loans. Bankers were extremely conservative. Then you have another in 91. What is 91? 91 is the S&L crisis. Major blow-ups, financial and other stuff. Again, bankers get extremely conservative. So, in bad times, bankers are conservative. And in good times, they loan up as much as they can. Alright? So, what might be good times? Over here, 86 through 89, you see, once they push the limit high, it usually falls off a cliff. Here, it was going up, falls off a cliff. Again, here it's rising, steadily staying, but here suddenly, the important to see is that in 2002, 3, possibly 4, bankers pushed the limit. They were loaning for cars by all means irresponsibly or recklessly. You know, loaning up 97% for the value of the car means what? that as soon as you loan the money, the same moment the purchase occurs, you guys all understand that the minute the car is driven off the parking lot, because that's considered the actual sale, so the minute it just drives through the door of the parking lot, that same minute the car loses anywhere between 5 and 10% of its value, right? I mean, that's just how it happens to be with cars. So, if they give you 97% for the purchase price of a car, you drive off the lot, and then the car falls by 5%, the loan is already underwater. Remember what's underwater mean? It simply means that the value of the loan is higher than the value of the house. This is also known and called in finance upside down. So, reckless lending simply meant that the loan was originated in the first place upside down or underwater. Well, this can't be any good, alright? Let's be done for today. Let's push up and you